A very warm welcome to all of you to this Policy Advocacy Committee meeting, probably our first online policy advocacy meeting after a very long time. Let me start off by inviting the chairman of the ABA, Jonathan Alice, to make his opening remarks, and then we'll get on to the meeting proper.
Distinguished members who are presenting papers this afternoon, ladies and gentlemen, a very good day to you all. As ABA Chairman, I'm pleased to welcome you to the first ever online meeting of the ABA Policy Advocacy Committee. I would therefore like to once again convey my gratitude to all of you for attending today's online conference. Your kind presence certainly shows your continued commitment to our association and what it stands for, and this we deeply appreciate. Let me especially thank those who are presenting papers this afternoon who have generously agreed to share with us their knowledge and expertise on policy issues of current concern to the banking community. I'm sure their insightful inputs will add great value to our deliberations.
It's a great honor for me to see each of you on the screen and to welcome you once again for this online Policy Advocacy Committee meeting. Let me very quickly run through the papers that we will be presenting today. First, on behalf of Hatton National Bank, my colleague Suresh Emmanuel will be presenting HNB's paper on cyber security preparedness. This will be followed by a presentation by the Rizal Commercial Banking Corporation from the Philippines on RCBC's experience in crisis and disaster preparedness and recovery efforts. Next will be our partner from WWF Singapore, who will present a paper entitled From Risk to Resilience, the need for Asian banks to comprehensively address physical climate risks. Thereafter, our member banks from Malaysia, Maybank, will make a presentation on the bank's experience in collaborating with fintech companies and addressing the challenges they face in doing so. This will be followed by a presentation by Erste Group Bank, Oliver Hoffman, on alternative benchmarks following the non-availability of LIBOR in 2021 and how banks can prepare for it. And the final paper presenter from the Bank of East Asia will discuss a structured cyber security cooperation model based on people, process, and technology framework for strengthening the cyber security controls. Lastly, we would like to solicit your suggestions on policy advocacy issues or concerns for the future policy advocacy works of the committee. If I may start with HNB's presentation last, if that is okay, and we start with the paper on promoting cooperation in crisis and disaster preparedness and recovery. So may I call on the representatives from RCBC, Ms. Cristina Alvarez, Senior Vice President and Head Corporate Planning Group at RCBC, to kindly make a summary report on the paper.
Thank you for this opportunity to share our experience in RCBC. So ABA Chairman, Mr. Jonathan Alice, Committee Chairman, Mr. Dilshan Rodrigo, members of the ABA Board of Directors and fellow presenters. It is a privilege to have this chance to share with you our experience in RCBC in crisis management, particularly in this time of pandemic crisis. We start with a bold question that takes on a bit of an optimistic view of the situation. We realized over the past 8 months that this optimism can also be contagious. In the following slides, we will share with you how we have balanced crisis management and the ability to thrive. The Philippines implemented one of the longest and strictest lockdowns. We call it the Enhanced Community Quarantine, and this was from March 16 to May 31. Today, we are in general community quarantine, and the government has been slowly opening up and relaxing some restrictions, although still with strict guidelines on masks, face shields, and mass gatherings. The Philippine economy continued to contract in the third quarter by 11.5%, although at a slower pace from the 16.9% contraction in the second quarter. The average GDP for year-to-date September is now negative 9.7%. At the start of the lockdown, we began an assessment of the industries as we knew some would be affected more significantly than others. The assessment was based on the degree of impact and the ability to recover. Real estate, travel, hotel, and accommodations are widely known to be severely impacted by this crisis. Although with the prolonged quarantine, we will have to review once more the ability to recover of these industries. In response, the government took on a wide range of measures, some of which had an impact on the banking industry. There is the Bayanihan to Heal as One Act. Bayanihan is derived from the Filipino word bayan, or meaning town or community. So bayanihan can be translated as being a community or used to refer to a spirit of communal unity and cooperation. So all banks, in the spirit of bayanihan, offered a payment holiday and most recently, a 60-day grace period for loans falling due on or before December 31. This covers all loans of individuals, households, and SMEs and corporate borrowers. Let me now go through RCBC's strategy to thrive in this new normal. The first set of strategies, defend and protect. Priority number 1, protect the lives of the RCBC bankers who have become frontliners. Next, defend the bank against loan defaults. And lastly, because of lower volume of business, cut expenses in a meaningful way. As early as January 22, the bank activated its pandemic and infectious disease plan, that is workplace hygiene, split operations, and work from home. These were key components of our response. We divided the organization into clusters. Laptops and small computers and VPN connections were deployed. At the start of the quarantine in March, majority were already ready to work from home. Most of our salespeople, our relationship managers were already mobile and equipped to work anywhere. Branches and branch personnel were properly equipped with shields and masks, and acrylic panels were set up in the branches. It was not easy to mobilize and distribute given the restrictions, but many were willing to take the risk so that we could deliver our banking services. The prolonged quarantine changed the complexity of the loan portfolio. The attitude we decided to bring into this strategy was to be proactive and engage the customer early on and to be responsive to their needs. The lending groups and the supporting credit teams were very busy for most part of the second quarter with trainings, meetings, customer calls, and account assessments. We are now at the post-ECQ execution. And while the message that we are here for you is still quite clear, the tone may be different and conversations are tougher this time. And this is why customer engagement is equally a critical strategy. From day one of the quarantine, the marching orders were to keep in touch with the customer. Without face-to-face meetings or interactions, defending our position with our clients meant we had to maximize all channels, mobile channels, social media platforms, and online meeting platforms such as Zoom. Streamlining operations. Cost-cutting is never easy. So how does an organization streamline operations during a crisis? The lockdown forced us to radically change how we spend. The expense budgets were practically thrown out the window, and the groups were asked to operate on a new set of guidelines. Priorities were set, and any spending other than those priorities would have to be justified at the highest management level. The quarantine also accelerated the shift to digital channels. At the height, only 50% or so branches in Luzon were able to open. And it might take some time for branch transactions to return to pre-COVID levels. In the meantime, the consolidation of certain branches based on performance and location can generate the needed cost savings. In redesign, industrial engineers were deployed as early as 2019. So redesigning business processes, including the reduction of traditional layers, continues to be a key strategy. And where repetitive manual tasks can be automated, robotic processes are incorporated into branch operations. The next set of strategies are focused on business recovery and to attack opportunities. With new priorities came new roles. The shift in volume of activity from sales to collection needed to be addressed. The customer needed a new channel to continue banking and transacting with us. The answer, the RCBC mobile app and other digital services. The crisis made it even clearer that the large unbanked population had to be addressed. The country's poor also needed a way to receive and transfer funds during the quarantine, especially with the cash assistance provided by the government. Coming into 2020, the organization was geared for growth. But post-quarantine, bulk of the transactions converged in the intense process of credit assessment, collection, and refinancing. By training and redeploying account officers, we improved the bottlenecks in this area. Customers also weren't coming to the branches still, so we had to move them to the digital platform. Branch and sales service teams were given the mandate to learn and then assist their customers to use our bank's digital platform and applications. This is the RCBC app. It is superior in features and banking functions and is well rated by Android and iOS users. The features from the latest update were responsive to the emerging needs while in quarantine. QR funds transfer, popularly used for online purchases, and local remittances. Check deposits and cardless withdrawal are distinct features of the app. But there's more. Updates on RCBC app include 4 more digital features: card installment, request payment, Forex, and soon to launch new investment features. The bank's strategy for crisis management incorporates a long-term view, particularly in nation building. RCBC responds to the needs of the unbanked and underserved Filipinos through First Rizal Microbank, the bank subsidiary for micro and small business enterprises. Second, our Discartec app, the country's first financial inclusion accelerator app. And for areas without a branch or an ATM, handheld terminals such as the ATM Go allows us to give access to those in the countryside. During this pandemic, the ATM Go was instrumental in the distribution of the government's social amelioration program, and the government partnered with RCBC to help distribute cash assistance to families greatly affected by the ECQ in provinces and remote locations. Customers embraced the digital platform and transactions increased significantly. Little did we know that our efforts would be recognized in the process. With 3 awards for a digital push, we are thankful. We also hope that setting sustainable goals will allow us to manage environmental or climate-related crises better. In 2019, with our sustainable finance framework in place, the bank issued the first peso-denominated sustainable bond in the Philippines. We still have a long way to go on building a green sustainable portfolio, but we know that this start is important. Before we end, we would just like to share with you how a particular group in our crisis management team spent their day yesterday. Typhoon Vamco, or locally known as Typhoon Ulysses, brought in so much rain between November 11 and November 12, resulting to severe flooding in the cities, leaving several households trapped. This team went out to rescue trapped and stranded employees and even some clients. We think of crisis management and recovery. When we think of crisis management and recovery, it becomes clear that our community must recover along with us. Thank you.
Thank you, Mrs. Alvarez. That was a very informative and an impressive presentation. Can I just clarify a couple of points, Ms. Alvarez? One is in terms of the RPAs. Where were the main RPAs deployed, in what areas? And the second was on your branch rationalization program.
On the RPAs, we actually have as early as 2019, we had a plan called the Branch of Today program, and we were supposed to roll this out in majority of our branches. And today we have one branch in Makati, and that's in the Central Business District, that has already applied this RPA. And so filling out of forms, and the account opening forms and even transaction forms are now online. And so when you enter your name and you enter your typical transaction information, that already flows in automatically into the system, and it's easier for the customer to transact and faster.
Right. Thank you. And the branch rationalization? How
the branch
that
rationalization, yes. So the savings bank of RCBC was merged into the parent bank last year, and we saw that there were a lot of branches quite close to each other, and the plan was to really merge them and consolidate and maximize certain areas, and then also move open other branches in other areas or relocate them.
Okay, fine. Thank you. So there was a lot of support from the regulator on these initiatives.
Yes, of course. They were part of the discussion from the start, and of course, cost cutting as an objective is acceptable for the rationalization.
Can we move on to the next agenda item, consideration of a paper entitled From Risk to Resilience, the need for Asian banks to comprehensively address physical climate risks. Can I call upon Adrian, who's the Vice President of Sustainable Finance, Worldwide Fund for Nature in Singapore, to present us with the summary report?
So good afternoon, everyone. Today, I'll be presenting on the physical risks of climate change, with one major suggestion for the members of the Asian Bankers Association. And that is that we should be focusing much more on physical climate risks, including what can and must be done about them. This is a topic in which I have much personal and professional interest. My doctoral research focused on physical climate risks and how they affected financial institutions. And I've worked on this topic in one way or another for the last 10 years, either as an academic, consultant, or as a national advisor. Before we continue, by physical risks, I am specifically referring to the potential for losses as climate-related changes disrupt business operations, damage assets, and interrupt economic activity. They are especially problematic because they are growing. Their growth is non-linear. The problems they cause are location-specific, yet have systemic impacts. And because of data shortages, we don't really know much about them. So we do know, though, that physical risks are on the rise. Impacts from physical hazards will only increase in likelihood and intensity as natural capital deterioration and climate change continues to worsen. Physical risks as influenced by climate change will certainly increase until the goals of the Paris Climate Agreement are achieved, and they are on the left-hand side of the screen. This is because limiting the global average temperature rise to 2 degrees or 1.5 degrees above pre-industrial levels is to prevent catastrophic levels of physical risks, not to stop them from occurring. Unfortunately, current greenhouse gas emission reduction efforts are massively insufficient to achieve the goals of the Paris Climate Agreement, with current pledges estimated to result in about 3.1 to 3.7 degrees of global average temperature rise. Therefore, banks should only expect physical risks influenced by climate change to increase in the future. Precisely how much is difficult to project, and this is due to global and local environmental tipping points, as well as interactions associated between the climate and socio-economic systems. Physical risks can be projected to some extent, and this is through the use of scenario or stress testing. However, current data shortages mean their reliability is insufficient. So we know that physical risks are certainly going to increase, but we also know that they're going to grow in terms of their materiality. This is leading to much greater desire for these risks to be disclosed. Financial institutions should care and develop a comprehensive understanding of physical risks because this disclosure seems almost inevitable to become mandatory. And in fact, TCFD reporting has just become mandatory in the UK. This is because it's becoming abundantly clear that the current status quo, whereby short, medium, and long-term physical risks are ignored or underpriced, could lead to the collapse of our socio-economic system, with current estimates suggesting that up to 17% of global output could be affected each year. There are 6 main stakeholders driving physical risk disclosure efforts, and these are depicted on the right-hand side of your screen. These stakeholders are also pushing each other, which is why disclosure is practically inevitable. For instance, credit rating agencies are already incorporating physical risk when assessing sovereign debt ratings. The cornerstone to all these efforts is, of course, the International Paris Climate Agreement, and this is whereby all countries have agreed to make financial flows consistent with climate resilient development. And this means integrating physical risk considerations into financial transactions. However, that being said, physical risk disclosure doesn't itself really resolve much. The aim must be to tackle physical risk at its source and the impacts it has subsequently on the financial system. So what really are physical risks? Well, firstly, it's important to note that we shouldn't confuse physical risks with physical hazards. Physical risks refer to the likelihood of hazardous nature-related events occurring, multiplied by their impact when they occur. Physical risk is therefore a quite complex concept, and it requires knowledge on natural hazards and their potential occurrences, exposure of business activity and assets to physical hazards, the sensitivity of business activities and assets, and the adaptive capacity of stakeholders. So what we can see across different types of economies, the same hazard will have different impact. And so you could contrast perhaps the way cyclones affect the Philippines to the way that cyclones affect Japan. So physical risks are often categorized into 2 distinct groups. These are acute risks, otherwise known as event-driven or rapid onset risks, and chronic risks, otherwise known as long-term shifts or slow onset risks. Acute risks are caused by acute hazards, such as tropical cyclones or flooding, and chronic risks are caused by chronic hazards, such as sea level rise or precipitation or temperature changes, including changes in variability. Often, the discussion tends to focus on only climate change related physical risks, but I actually personally see this as a bit of an oddity. Physical hazards have multiple causes, so there is no single event caused by climate change. It is often a mixture of climate change and perhaps environmental degradation. And the main concern that banks should have is not really what the causes of physical risks, but the extent of their materiality within the context they are being considered. Corporate exposure to physical risks can be thought of as first-order impacts and second-order impacts, both of which affect corporate financial performance, capital expenditure, and operating expenditure. An example of first-order impacts is like the direct implications of physical hazards on operations and assets, supply chains, and markets. In terms of second-order impacts, this is how physical hazards affect the natural environment or societies and our political systems. And these are difficult to predict or manage through traditional risk management approaches, since they're highly context specific and will even differ at localized levels. So on the right-hand side of your screen, there is a general sort of framework for how we would think how physical risks affect corporates. And in terms of the types of factors we can consider, this could be a reliance upon natural resources or secure energy supplies or climate sensitive supplies, the reliance on secure transport routes and so on. And it is likely that banks will need to integrate these types of concerns when they're performing credit risk assessments. Physical risks are so material that they can and will cause the bankruptcy of major companies. The most well-known example of this was Pacific Gas and Electric Company in California, which recently went bankrupt after its energy distribution infrastructure sparked wildfires, which caused billions of dollars worth of damage. It is often recommended that banks do not consider physical risk as a unique risk factor in its own right, but to consider it within the framework of existing risk factors. And this is because physical risk is a transverse risk, whose impact banks will experience in terms of credit risk, market risk, liquidity risk, and operational risk. And this is perhaps often why bankers don't really see the impact of physical risk itself. It's because we'll experience it through increased transaction risk, where businesses will increasingly be late or have non-repayment of loans. We'll increasingly see it as demographic risk, because when physical hazards occur, we generally see a reduction in consumption and the demand for goods and services. We'll also see enhanced liquidity risk, because when physical hazards occur, we tend to see deposit withdrawals increase and late loan repayments, which frustrate the ability to efficiently meet cash obligations. And we'll also see increased regulatory risks, such as the position of banks to disclose their risks in line with the TCFD framework. Now, there are a number of tools and resources out there which can help banks identify physical risk, and some of these are on the screen. There are also a growing number of specialized service providers. I haven't introduced them here today because they're as profit-making entities. I don't want to be sort of inadvertently advertising one above the other. So in practice, the process for reporting physical risk differs little across the TCFD framework relative to transition risk, where most attention is being given. Banks themselves, or could also request that clients follow the standard and supplementary guidance for governance strategy and risk management disclosures. So for instance, the board's oversight of physical risks and opportunities, the management's role in assessing and managing physical risks and opportunities, perhaps the impact of physical risks and opportunities in strategy and financial planning, the resilience of those strategies and plans in accordance to different climate scenarios. And in fact, the metrics and targets component of the TCFD framework is only really where disclosure on physical risk has become different. And that's because there is no unique universal metric existing to measure physical risks due to its unique context. So what would a bank, though, disclose in related to physical risk? Well, the Climate Finance Risk Forum in the UK, which is our industry initiative, has suggested that banks could report on the proportion of portfolio highly exposed to physical risks and provide any indication of the concentration of risk in certain sectors. It could look at credit exposure of portfolio in relation to key indicators of physical risk. It could also look for quantitative scenario-based impairment metrics. In addition, you could also perhaps report on the proportion of your activities or clients without relevant insurance, or those which simply couldn't obtain insurance. Banks could probably also require their clients to report on the impacts of recent extreme weather events, the impacts of weather variability, perhaps also the future physical risks, and also physical risk management. So, for instance, net risk exposure after risk management and insurance. But this is in itself just about disclosure. So what we really need to do is to manage and reduce that risk over the long term. And that's where these concepts of adaptation and resilience need to come into play. Adaptation is the process of adjusting to actual expected climate change, seeking to moderate or avoid harm or exploit beneficial opportunities. opportunities. In contrast, resilience is fundamentally about coping. So the capacity of a corporate or a bank to absorb that shock, to rebound, and to sort of learn from those experiences and reconfigure itself in the future. We also need to be aware that there are private and public forms of adaptation. In terms of sheer quantity, most adaptations will be private, addressing location and context-specific physical risks on an economic activity. But the most significant will be public, reducing physical risks on natural or built environments within which economic activities take place for public benefit. Unfortunately, there is a substantial lack of public investment in adaptation, which means that physical risks are building up in the real economy, and banks cannot escape that as risk aggregators. A recent study by the UN suggested that beyond 2030, annual investments in adaptation could increase up to 500 billion per year. So increasing investment in public efforts is vital, as they tend to have systemic level effects, but they also enable private adaptations by corporates to take place and consequently for investment to flow. But we also need to be aware of limits and barriers to adaptation. And this is why everyone is so focused on mitigation with the climate change sphere. So adaptation barriers are resolvable issues, which either restrict the ability of a corporate to adapt, or the range of adaptation options available to a corporate, perhaps even the effectiveness of those adaptation options. And understanding adaptation barriers for banks is important, because eliminating or reducing the impact of these barriers should in turn enable investment to flow to efforts which tackle physical risk. Adaptation limits, on the other hand, prevent adaptation from occurring. And that is important to note, because adaptation is not always possible. And it highlights the fact that there is and will always be residual loss and damage due to climate change. So in terms of my final slide, I want to argue that we need to first identify these physical risks, incorporate it into management processes, but we need to be moving towards resilience as financial institutions, but also ensure that our clients are also thinking about their resilience to physical risks. Unfortunately, when it comes to the real economy and for financial institutions, there's not really been that much discussion about what resilience means and how to measure it. Because once we can measure it, we can start to understand how we can improve it. But generally speaking, from the international development sector, it's these types of characteristics on your screen right now, which would be a characteristic of an entity which is resilient, i.e. there's something to do with the capitals and assets it has available, the knowledge and information it has, but also importantly, how innovative and flexible its governance is to react to changing conditions in the future.
Thank you, Doctor. It was a very interesting and very passionate presentation. You know, there is a popular view that COVID-19, the global pandemic, is nature's way to slow population growth and economic activity around the world, and thereby, you know, give more prominence to the physical risks that you mentioned and safeguarding our environment. Do you subscribe to that view, and do you feel that if there are lessons to be learned, those lessons have been learned by governments and the regulatory bodies?
I think first and foremost, what's happened with COVID-19 symbolically shows the sensitivity of our social economic systems to the natural world, and perhaps that we have ignored the balance between the natural world and our human systems for far too long. The major point to note with this COVID-19 and subsequent recovery efforts is that in order for us to successfully recover from COVID-19, we must also become resilient to climate change, because there simply won't be enough capital available to do both. We don't have enough capital to return our economic system to the way it was and then subsequently try to change it to be resilient about climate change. It has to be aligned. So we need a green economic recovery.
Now, can I move on to the next agenda item? Consideration of a paper on promoting cooperation efforts in collaborating with fintech companies. May I now request Mr. Lionel Jose Kang, Head Digital Strategy, GS Group Digital at Maybank, to make a summary presentation of this paper.
Good afternoon, Chairman Alice, members of the ABA Policy Committee, invitees and colleagues. I'm Lionel Ho, representing Maybank in the capacity of Digital Strategy. On behalf of the Maybank Group, we thank you for extending this opportunity for us to share some of our views on the pertinent issue of coexistence between banks and fintechs. I will highlight some of the realities and also some of the ways that we have approached this interesting convergence, and will attempt to address any questions you may have at the end of the brief presentation. I'm certain that few would disagree with the proposition that the world is undergoing rapid digitization, which is being further accelerated by the realities of COVID. This is particularly true in financial services, where it can be argued that in the 3 to 5 years prior, digital entrants had been steadily emerging throughout the world. The addressable need was in the form of heightened demand for better service and value and increased convenience. Payment startups have been the most prevalent, with PayPal, Stripe, and Adyen playing key roles in the democratization of payments enablement and acceptance globally. They've executed well to create highly valuable infrastructure services that fill in the gap in global payments. Competition has been fierce. Then there are the super apps with WeChat and Alipay in China and Grab and Gojek in ASEAN. They have provided convenient digital lifestyle, e-commerce and aggregation services underpinned by resilient payments and credit infrastructure that in some cases has successfully served multiple countries, as in the case of Grab and Gojek. Then finally, but not least, are the big tech ecosystem providers like the brands you see here. They have been leading in their fields thus far, but are facing mounting challenges from concerns over monopolistic behavior, data use, and dominance. They too have payments ambitions, but while ambitious, have faced challenges in coming to market in a big way. Each party in the financial services ecosystem faces its own challenges as each comes from different perspectives. Partnerships are the key strategy to achieve synergistic propositions that focus on creating rather than destroying value for all stakeholders, rather than just shareholders. Winner takes all and race to zero business models that tech is infamous for are increasingly difficult to support from a perspective of sustainability, especially when the pandemic has created a real threat to traditional physical business models. On the one hand, banks have concerns over how visible data sharing can be, concerns over being disintermediated, and the perceived lack of stickiness in the products or services banks provide. On the other hand, many fintechs face an uphill climb to establish long-term trust, scale, regulatory compliance, and size of customer base. Of course, the bigger ones have already achieved economies of scale and a level of discipline and maturity that has prepared them to compete directly with banks. But again, in the spirit of co-opetition, it is vital that sustainable partnerships are formed for the sake of customers and stakeholders. Government policies play a vital role in setting the tone of what is and is not acceptable. To their credit, regulators have played a proactive role in seeking to understand the emerging business models and have in some cases weighed in on areas that require supervision. These regulations, when drafted fairly to address the concerns of all sides, can serve as a facilitator rather than a barrier that most perceive, particularly the entrants. Banks, as incumbents, are very used to significant regulation and have arguably built up this core capability for decades. This is why there is a degree of trust in the banking system. Regulators need to strike a balance between advancement and innovation, as well as the safety and stability of the financial services system. An interesting case study is just days old, Ant Financial. Everyone knows its IPO was stalled as there were concerns raised by the regulator at the 11th hour regarding Ant's perceived ability to create enormous new microcredit opportunities for the masses without sharing in the risk. It was reported that Ant would be required to take up to 30% of the risk of the digital microloans that it facilitates between banks and customers versus just the 2% that it takes today. This is an example of regulators intervening when things get too hot. Many have cried foul over the timing of this clampdown, but the decisions were made and the world has been reminded of the need for caution with regards to financial services. In Malaysia, we are very blessed that Bank Negara Malaysia, or BNM, has been keenly observing the global and local developments and played a very proactive role in approaching this matter. They have a team of young professionals who seek to understand the various perspectives, concerns, and propose viable solutions that achieve the balance I mentioned earlier. As such, BNM has demonstrated its commitment to facilitate this coexistence by investing in 3 key areas. Firstly, interoperable payments structures. Secondly, a dynamic approach to supervision and regulation. And thirdly, strengthening collaboration platforms so that players can focus on creating value together. This focus by BNM is evident in 2 key items I would like to highlight. There is firstly the Do It Now framework and platform, which enables instant credit transfers that are tied to our national ID and mobile numbers. We have done away with the need to list down our bank account numbers to do transfers. We just look through our phone book. Our smartphone book. It's a significantly better user experience for all participants and removes duplications. They are also working on an interoperable QR code system to avoid having multiple physical QRs at merchants, which has been a mess at times. Secondly, BNM has issued a policy document that recommends standards for the development and publishing of open APIs in the areas of credit cards, SME financing, and motor insurance or takaful, which, as you can guess, are key areas of interest for the fintechs. Of course, the digital arena is very fluid, and regulators are comparing notes when it comes to the upcoming themes that require enhanced oversight. There's open banking, which has unfortunately encountered significant delays and execution issues in EU and Australia. Then there are interoperable payment frameworks, particularly those that enable cross-border national digital payments between countries. Of course, the DigiBank frameworks in ASEAN, where in Hong Kong we have seen the launch of quite a few new entrants already. National ID and eKYC frameworks to enable fully digital account opening. Central bank digital currencies, which is an upcoming hot topic, currently being advanced significantly by China. And finally, banking as a service. We feel there are essentially 5 key challenges that need to be addressed in promoting improved cooperation or co-opetition between banks and fintechs. Firstly, we should compete, as that is the essence of bringing out the best of our offerings to the marketplace. But as mentioned before, this should be done by minimizing the destruction of value and cannibalization. In essence, synergize more, sacrifice less. Secondly, stakeholders must work together to manage regulatory oversight differences. In our experience collaborating with fintechs, we have seen a relatively lighter approach taken by regulators on them, which is understandable to a degree. But the key is maintaining open dialogue such that valid concerns are addressed in a timely manner and a collaborative atmosphere is maintained. Thirdly, there are clearly cultural differences. These span multiple facets from management rigor and communication style, how each party views success, concerns over data privacy, do first, check later, and perhaps by their startup nature, they sometimes favor rigorous experimentation and, in inverted commas, failing fast, which is to bankers sometimes a very loaded statement. Having said that, we have found that open and frequent communication and alignment has helped bridge the cultural gap and allowed us to maintain very healthy working partnerships. We have demonstrated our commitment to rapid execution and a great degree of transparency regarding data and an energy and pace that has at times surprised our partners. Fourthly, there is the challenge of data privacy, identity, and rights to manage the data. Partnerships have at times made this consideration more complex and strategic, but we have managed this by clearly communicating with our customers on why their data is needed, how it is used, as well as ensured that our data practices during the collaboration or otherwise are in full accordance with local regulations. And finally, the creation of new risks and exposures with the introduction of new products. Banks have a compliance-first culture, and in recent years, fintechs have matured in this sense to a certain degree. But again, the way to address this is a more rapid dialogue between all stakeholders, such that ideas and concepts can achieve alignment, or at least clarity with regards to acceptability as soon as possible. We've also found that a semi-flexible approach to governance processes has helped balance regulatory compliance with a dynamism to address emerging market needs. In closing, partnerships in the digital era are more important than ever. There are gaps that need to be addressed, but the relationship between the incumbents, regulators, and entrants can be worked upon on a daily basis to ensure parties communicate clearly, regularly, and productively, such that the entire ecosystem strikes that delicate balance between innovation and systemic safety. We cannot achieve our visions and strategy without a thorough focus on executing. While executing on strategic partnerships can be sometimes messy, painful, conflicted, or even awkward, the way forward is clear. We must step in time with new ideas and market participants, such that all stakeholders are able to enjoy a rising tide together.
Thank you, Mr. Se Kwang. Very interesting presentation. Let me start. I would like to ask a question. What has Maybank's experience been collaborating with some of the fintechs? What were the key areas that you collaborated on, and what have been the the best areas where you feel things have worked out very well?
We have been partnering with quite a lot of the big tech firms. In particular, the e-commerce players, Lazada, Shopee, and of course, because in Malaysia we have the benefit of incumbency, we collaborate extensively with the more BAU type fintechs, payment aggregators, and those who introduce new payment services or modalities. But there is one partnership that we are particularly proud of, which is with Grab. And not many people know this, but we entered into a strategic partnership with them in 2018, and we've had quite a productive relationship. And those points that I mentioned just now apply directly to the relationship with Grab. To their credit, Grab has been significantly maturing at a rapid pace with regards to the matter of compliance. And the so-called slash and burn aggressive tactics, I think we've seen them pull back somewhat once Uber left the arena. So those 5 challenges are very real, and those were what we experienced during our current collaboration with them. But I have to say, and with with thankfulness that we have managed to, as a bank, transform significantly in terms of our attitudes and our approach to design and rolling out offerings. So if you have time, I'd encourage you to have a look at our new digital bank app, which is called May by Maybank to You. We are very proud of it. We've just launched it a few weeks ago. It's like banking cum lifestyle app, and we're very proud of it and hope that it will reach the targeted audience as soon as possible.
Thank you. I'll certainly take a look. So I would like to then call upon Oliver to make his paper. I think this is the third in a series of papers we've had on the LIBOR transition. Consideration exploring the LIBOR transition after 2021 and its implications for member banks.
Yeah, as Dilshan mentioned, this is the second or the third in a presentation, a series on the LIBOR transition. I did a presentation on the same topic last year in the committee meeting in Manila. That presentation already addressed a number of the fundamental issues that are out there with LIBOR and with ARRs. So in this presentation today, I will not go into all these fundamental issues again because they haven't really changed. I will try to concentrate on the developments we have seen since we met or since we spoke last about this topic. a small apology. At the beginning, I violated quite a number of PowerPoint rules. A lot of the slides have way too much text on them. Basically, this paper would have been in a better format, would be a Word format to read in a quiet moment, but I thought for sharing on the screen, PowerPoint would be the better one. So with that said, let's start. On page 3, you can see a summary of the 5 major alternative reference rates we are currently looking at, and what has changed here. As a European bank, of course, here as the bank, we are especially interested in the euro rates, and I'll talk about them in a bit more detail later in the presentation. The most actively used rate, the alternative rate at this point probably is in pound sterling, the SONIA rate. I think the Bank of England also is the central bank pushing the most for reform in the sector. Maybe that has to do with the fact that most of the LIBOR problems originated in London, but I'm not sure that's the only reason. Then on the Swiss franc rate, the SARON, that at this point is the only of the ARRs where the National Working Group does not recommend to have term rates, but again, it's nothing is final here yet. And with specific regard to Asia, we should note that there are a number of Asian benchmarks that are derived by applying a forward FX curve to the US dollar LIBOR curve. So if you have no longer a US dollar LIBOR, obviously these Asian benchmarks will also have to look for alternatives too. Moving on to the next page, just a bit of update on the number on the ratios of transactions. Here you can see that the ARR volume has gone up quite a bit, but compared to the total volume, including the IBORs, it still is very tiny, I would say. This example here is for interest rate derivatives, and again, though the increase has been there, but the absolute volume is still tiny. Of course, 2020 is not a great year for any comparison. The mayhem caused by the virus distorted the market activity substantially, though we have seen things, especially in the financial markets, come back to more normal levels over the past few months. But you will remember the market panic that was out there in March. And in this graph, you can see the massive effect this had on the IBORs. The green line is the US dollar LIBOR, the light blue line is the pound sterling LIBOR, whereas the effect on the US SOFR, on the alternative reference rate, has not been that large at all. So there's a massive divergence between the IBORs and the ARRs, and that underlines the need to have a spread adjustment here. This slide, again, this is one of the bad PowerPoint slides. I don't think you can read anything here. Basically, what we have here are the milestones for the benchmarks transition. If we look at the ones that are coming up, I think the most important ones will be towards upcoming ones will be towards the end of the year. At the end of this year, Swiss franc cash products will move from Swiss franc LIBOR to SARON. The Alternative Reference Rate Committee in the US has recommended that as of end of this year, the banks in the US should stop issuing LIBOR FRNs from that date on. By the end of the year, we also should have SONIA term rates in place, which would be a big help. Locally, here in Hong Kong, the HKMA has asked banks to stop LIBOR-linked issuance with a maturity beyond 2021, by the latest by June 2021. For those of you who use Condor or Condor Plus as front office system, Finastra has announced that they will equip the system with an IBOR transition functionality in February 2021. So as I mentioned, we want to look a bit more in detail on the Eurozone, being one of the largest banks in the Eurozone. Obviously, we are very actively involved here. We're also part of the the Euro Working Group. The EU Commission in August this year did a review of the benchmark regulation and published a proposal that in case the benchmark transition causes a significant market disruption in the EU, for example, when large numbers of market participants cannot come to an agreement on the replacement of the IBORs, then the EU Commission would have the power to designate a statutory replacement benchmark. And this statutory replacement benchmark would be made a matter of law by this avoiding or rather overruling contractual conflicts. That is a proposal by the EU Commission. We will see if it comes to that. If it does, I would expect massive legal issues here. But again, this is really for the worst case when the market cannot come to an agreement. It's important to note that the timeline for the replacement of Euribor is different than that for LIBOR. There is no firm date yet for the cessation of Euribor. It most certainly will not be on 31st of December 2021. My colleagues in Europe, they do expect a replacement, but that could be down the line as long as 5 years. So the reformed Euribor may be around for quite a while. On page 8, I have listed the two key challenges I do see for banks, and for me that is term rates and spread adjustments, or rather the lack of term rates in ARRs. What we're basically trying to do is going from forward-looking rates with a liquidity and a risk premium to determining the rates in arrears and on a risk-free basis. So quite a difference from what we have been doing all these years. How do we solve these issues? There are a number of options and avenues being explored at the moment with regard to the term rates. What we expect to happen is that forward-looking futures-based rates will develop, at least for SOFR and for SONIA, but that really depends on daily futures volumes and liquidity building up in a meaningful way, which so far has not happened yet. But again, we expect that to increase and then term rates to be developed. Regarding the spread adjustments, you saw on page 4 how important the spread adjustment would be to adequately reflect market credit and liquidity risk for the banks to maintain the interest rate returns. The expectation here is that we will follow the ISDA derivatives spread adjustment methodology also for cash products. That means spread adjustment would be done on a 5-year median difference between LIBOR and the ARR compounded in arrears, because ISTA is, let's say, is advanced on the protocol, what they will do with for derivatives, and we expect the cash market basically to copy some of that. Bloomberg already has introduced a number of function and is publishing daily adjusted ARRs. So that is helpful here, and you can check this out on Bloomberg, what is already out there. So looking a bit more at the situation here in Asia, there have been a number of surveys by rating agencies, by industry associations, by the media, and by the regulators. Here in Hong Kong, we just submitted a survey to the HKMA, or the HKMA asked us to complete it. I think you can summarize the main trends in these 4 bullet points here. One, most banks say, despite of COVID and what happened this year, their transition plans are on track, though there's a bit of a feeling, we still have a year to go, and a lot will be left to the very last minute, as usual. That's what I expect. ARR related exposure in most banks in the region has grown, but the absolute volume still remains small. You saw that on page 4. There's still a very substantial volumes being done linked to IBORs, and that again I expect to continue until the very last minute. Of course, increased attention now is being given to have proper fallback language in the documentation. And lastly, the key challenges most banks see is, one, insufficient liquidity in ARR products so far. Second, the fallback implementation. Third, the updates that have to be made to systems and models. And fourth, lastly, the valuation impact. On page 10, this is a summary of readiness of banks in different countries in Asia for the ARR transition. This is based on the surveys I mentioned before. It is a bit subjective, but just to give you a rough idea, and I guess no surprise, places like Australia, Hong Kong, New Zealand and Singapore seem to be the most advanced in the process at this point. The ABA asked for a checklist for banks. So what I put in here for you is a checklist basically put together by ASIFMA, APLMA, ICMA, and ISTA. You can use that to go through the points and tick the boxes, hopefully tick all the boxes for your bank. What I would look at right now, would not waste lose any more time looking at, is to check in some legal aspects in your jurisdiction. I think it's very important to be in the clear on that. One, are there any legal impediments to applying compounded averages and applying them in arrear? Second, are there any legal issues that interest is calculated based on a different time period than the actual interest period? Third, does your jurisdiction allow for an adequate lag period? I mean, the lag period is designed to allow the lender to inform the borrower about the interest to be paid in arrears, and then for the borrower to make preparations to pay that interest on the agreed date. And lastly is a primary ARR screen rate available for use in your jurisdiction. So these are the 4 points I think I would start with to look at, then take the checklist, go through with your teams and see where there are issues where you need to step up the preparation. Thank you.
Thank you, Oliver. A very comprehensive presentation. Just a quick question. Do you feel that given the ARR readiness varying between jurisdictions, the smaller jurisdictions, the smaller banks, smaller countries in Asia will have to piggyback initially on the more established financial markets like Singapore, London, Hong Kong, until they get their own benchmark rates addressed?
Mm-hmm. Yeah, I think that is one avenue, and especially if you're as one of these banks, if you're a participant in a syndicated loan, for example, you will have no chance but to follow whatever is decided for that loan by the majority of lenders or by the arrangers. In a number of Asian countries, you will continue to have IBORs. Again, the deadline for end of 2021 applies only to some of the major IBORs and not to all of them, like in Hong Kong. We will continue to have HIBOR. We have HONYA now too, but again, HIBOR is there to stay. I think in Australia you have the BBSW there. Singapore declared that they will want to move away from SIBOR, but again, there's no fixed date yet. So you may have some local IBORs post 2021, but for the big international issues, yes, you will have to follow whatever is decided there.
Thank you once again, Oliver. Or can I move on to the 2 papers on cybersecurity? Starting with Mr. Wong, from who's a group CIO and general manager and head of technology and productivity of the Bank of East Asia.
Okay, so my name is Eric Wong from the Bank of East Asia. Thank you very much for inviting me to this meeting today. I'm delighted to have this opportunity to share with you about the importance of cooperation in cybersecurity and management and how we should strengthen this amongst banks, law enforcement agencies, regulators, and the public. In this session, we will first have an overview on the latest cyber threat landscape during the COVID-19 pandemic. I will also share with you the 3 key pillars of cooperation in cybersecurity management by referencing the information sharing activities, innovation, and continued effort putting in cybersecurity and the relevant regulatory engagements in Hong Kong. The past year actually has been a very challenging time for all of us, especially the banking industry around the world. The COVID-19 pandemic is causing serious disruption to the banking operation by changing many daily routines in considerable short time. The COVID-19 situation also forced the banks and individuals to embrace new practices such as social distancing and remote working. While the banks are focusing on adopting the new norms and standards posed by the COVID-19, cyber criminals around the world undoubtedly are capitalizing on this crisis. In a global survey recently carried out by the Information System Audit and Control Association, an international professional body focusing on IT governance and information security, based on the research, over 30% of cybersecurity practitioners believe cyber attacks will keep growing, where over 40% of these attacks are committed by the cyber criminal and the hackers. Cyberspace is one of the key influencers and drivers of the social and economic growth by providing new means for people connection, interaction, and collaboration. Cyberspace and the related emerging technologies have assumed a new importance in the global response to the pandemic. However, at the same time, the malicious actors have rapidly adapted to this response, and this in turn has led to a shift in attack surface and methods. For example, video conferencing has become the primary channel for meeting, just like what we are doing now. Reliance on remote connectivity, such as corporate VPNs, has also been ramped up, and cloud services has justified their usefulness around the world. As a result, cyber criminals, hackers have redirected their attention to this system as initial entry point to their target. Cyber attacks are become more advanced and sophisticated. Some attacks are not aware until they actually occur. Cyber incident risks are inevitable. It will be too ideal if one expects complete prevention of cyber attack merely by implementing control only. To tackle with this inevitable trend require not only robust cybersecurity defense by a single entity, but also cross-vector cooperation amongst banks, law enforcement agencies, regulators, and the public. So given the importance that we attach to promoting cooperation on cybersecurity management here, what will be the critical success factor on implementing this effectively? To answer these questions, let me share with you what we did in Hong Kong. In the past few years, the banks, law enforcement agencies, and regulators in Hong Kong have cooperated and sought to make the cyberspace more secure and reliable for the public. This cross-vector cooperation has been structured and operated smoothly. The operating model can be summarized, as you see in this slide, based on the people, process, and technology framework. I will explain this framework in more details in the following slide. Before talking about the details of the operating model, let me share some examples of the cybersecurity cooperation work has been done in Hong Kong. First, the Hong Kong Monetary Authority's Cyber Security Fortification Initiative. It has been introduced by the Hong Kong Monetary Authority back to 2016 with the collaboration with the banking industry to introduce a three-pillar program in terms of cyber resilience framework, professional development, and intelligence sharing. Last year, the HKMA conducted an industry-wide consultation to collect feedback on the implementation and improvement going forward. The revamped CFI 2.0 has just been released in early this month. Secondly, the Hong Kong Police Force Cybersecurity Service. Following the establishment of Cybersecurity and Technology Crime Bureau, short named as CSTCB, by the Hong Kong Police Force in 2015, the CSTCB provides proactive cybersecurity support to different industries. For example, communication channel ensuring cyber threat intelligence, security trainings for the industry practitioners, and education and awareness to the public. Thirdly, cybersecurity related task force and working group has been set up within the banking industry, especially within the bank themselves, in sharing the latest cyber threat intelligence, prevention approach, and remediation measures. This multi-level cooperation work demonstrates the synergy effect across various stakeholders in defending cyber attack and addressing the cybercrime. Cybersecurity cooperation does offer a tremendous effect in protecting the cyberspace and the public from cyber criminals and hackers. When we look at the cybersecurity cooperation, we should first admit that no single organization has the knowledge covering all information and intelligence of cyber threat, vulnerabilities, and cyber attacks. And effective information sharing mechanism and process across the industry is very essential in order to avoid the frauds other peers suffer previously. Take Hong Kong as an example back to 2017. The HKMA and the Hong Kong Police Force and the cyber security communities had established a cyber threat intelligence sharing platform for the banking industry and eventually launched the platform across all industry in 2018. By proactively sharing indicator of compromise, later cyber attack approach and guidance on defense measures, this centralized community-driven platform help build effective cyber resilience and evolving immunity across industry and the region. Regarding technology, innovation and digital transformation play a major role in modern banking. Traditional use of technology, information security approach, and processes may not be able to fully address and respond to the incident and risk triggered by cybercrime. To cope with the risk of these banking innovations, banks' control functions should work hand in hand with the business in understanding the underlying technology solutions and evaluating relevant cybersecurity risks and controls. Let me highlight a few initiatives here in Hong Kong. One example is that the establishment of common baseline for open API adoption is a collective effort of the banking industry. The baseline serves as a foundation of emerging technology adoption in providing better customer experience and at the same time, providing a reasonable cybersecurity assurance to the public. Another example is the introduction of regulatory sandbox and chat room, which provide a platform for the banks to pilot their initiative together with their partnering technology firm, fintech firm, startup firm, whatsoever, in a controlled environment. For example, only to open to the internal staff and limited number of customers to dry run their initial application in order to contain the cyber security risk. And it also allows banks to understand the readiness of their service and relevant cybersecurity control and potential weaknesses prior to the public launch. Finally, on the people side, cybersecurity talent are always the most important and essential element in bringing and sustaining a successful cybersecurity cooperation. A recent study has identified a significant gap in cybersecurity threat, especially in high-skilled cybersecurity workforce. A lack of suitable talent will be a major obstacle to cybersecurity cooperation. One effective solution is to combine upskilling and sourcing new hires while uplifting the competency standard and enabling effective training. For example, the Hong Kong Monetary Authority, in collaboration with the banking industry and professional bodies, implement the enhanced competency framework on cybersecurity to provide guidelines and programs in training and developing both new entrants and existing practitioners. In conclusion, individual banks, law enforcement agency and regulator are continuously seeking innovative ways in using cyberspace to their advantage. However, many of them at the same time have been victims of the cyber attacks and cyber crimes. I trust that the ultimate goal is crystal clear, that a structured cybersecurity cooperation is not to completely prevent cyber attack. Instead, it aims to excel the cyber resilient capability of a single entity by leveraging the knowledge and experience across industry and regions. I hope that my presentation serves a very good reference to our structured cybersecurity cooperation in the banking industry. Cyber attack will never be stopped as long as the cyberspace exists. Therefore, it is very important that we put this cybersecurity cooperation as one of the highest priority items when you consider your own cybersecurity strategies. That's all for my presentation today.
Thank you, Mr. Wong. Just one question from me. What are your views on cyber risk insurance? Is that something that merits value either individually for certain areas or collectively for the organization?
Well, I think yes. The simple answer is yeah. I think the cybersecurity insurance is something that I think it will help you when you have of course, it will help you to contain some losses, right? I mean, it's a kind just like the normal health insurance, travel insurance, that kind. But more important that it also provide some forensic services normally bundled with this cybersecurity insurance. So when you get an attack, right, and then you need to engage some expertise, right, to help you to identify what is the impact, induced by this cyber attack, right? So in the process, then you can I mean, it's very important, right, to know what you have been lost or what kind of damaging have been imposed in order you calculate the total loss in terms of the financial terms or so ever. So I think that is very important. And also, I think at least in the Hong Kong, right, I think the regulator is also looking into the cybersecurity insurance is almost a must, for certain organizations.
Thank you. Thank you once again for that presentation. Let me move on to the last paper, which is on cybersecurity preparedness by Suresh Emmanuel, who is the Chief Information Security Officer at Hatton National Bank.
So good afternoon, everyone, and the ABA Chairman and the Executive Committee. So my presentation is primarily made on an approach where this paper can be used to practical and actual implementation for them to position strongly against the upcoming cyber attacks. And so this presentation is actually prepared in NIST framework as well. That's I would like to endorse prior to my presentation. And if you take today's banking context, basically the banks, due to the completeness, banks are opening different levels of channels to facilitate customers through innovation, and the different technologies are getting involved and all. So more and more the banks are actually innovating and finding ways and means to reach their customers. It actually opens the new challenges and the risks to the banks as well. So by considering this fact, actually this presentation was prepared in an approach to cybersecurity preparedness. For approaches actually to comes in mainly 5 segments, which is to identify, protect, detect, and respond. Detect, respond, and recover. So if I move on to the first point, which is the identify or the identification, that's where you the basic of any cybersecurity framework is coming in the setting up the business environment. So basically, when you set up the business environment, where you need to set your cybersecurity mission statements, which should be in line to the organization's business objectives and the strategies of the bank, specifically for the bank. And especially for the digital strategy, what are the digital channels coming in? What are the new ways and means of digital? Whether the bank is going for an open API-based banking strategy, or the bank is going for a chatbot kind of new facilitation to the customers. So based on all these banks' business alignment, the cybersecurity vision, mission, and the objective should be properly articulated and documented and approved and communicated. So that should be done as one of the priority thing in the bank. Then subsequent to the vision strategy, the cybersecurity strategy has to be articulated. And subsequently, when you articulate the cybersecurity strategy, you need to identify your regulatory, statutory, and the contractual obligations as well. So, for example, for a bank, banks have contractual obligation with the payment brands and certain global payment facilitation platforms like SWIFT and all. So those contractual obligations also should be considered when we articulating these strategies. Also, the critical success factors for cybersecurity also has to be considered. So subsequently, then the bank has to establish a proper governance. So after the setting up the business environment, establishing governance is one of the key important things. So appointment of the Chief Information Security Officer is one of the key things a bank must do. So where there are a key role in the bank in the executive committee of the bank, where who is accountable and responsible for driving the information security initiatives throughout the bank. So that has to be done. Then subsequently, the Information Security Steering Committee establishing them, and the reporting structure to up to the board risk committees, and establishing the policies, procedures, and also aligning them to a global practices. So those things are the basic basics when it comes to the cybersecurity framework, establishing a cybersecurity framework in a bank. And also a part of that, the bank has to also create an annual activity plan in terms aligning to the business objectives and the projects of the bank. So basically, annual cybersecurity activity plan also should be in line, or including the security testing plan, also should be in line with the business objectives and the deliverables of the bank. And bank should also define key performance indicators for cybersecurity and the information security function, where that bank can continuously monitor them, and also which can be helped to improve further in future. And asset identification is one of the key things when it comes to the principle of identify. So if you take for an example, we can't really protect something we don't identify. So simply that's the simple as it is. So the bank should have proper mechanisms to identify all its assets, including the software assets, digital assets, technology, whatever the process-based assets, and including the people assets as well, the key roles and the responsibilities of everyone. So all the upon identification of all these assets, the bank can actually prioritize and actually classify what are my important assets for the bank. So based on the classification, bank can actually consider in terms of allocating more controls over for the crown jewels of the bank. So the asset identification is one of the key important aspects. And the risk management function, the bank should have that the cybersecurity should be part of the bank's enterprise risk management framework. So apart from the self-control assessments the bank generally do for the evaluating of the technology risk, the cybersecurity related specific risk should be part of the bank's enterprise risk management framework, where that the board risk committee should take a regular agenda point as discussing the cybersecurity risk and the continued improvements, as well as whatever the incidents happens and all. So this practice actually creates a culture within the bank to continually improve the bank with cybersecurity framework and the cybersecurity related and technology related risk management strategy. So if you move on to the next principle, which is the protect. So the under protect is, so once we have the bank has established the identified, established the business environment and established the governance framework. Once the asset identification, risk management frameworks are established, now the protection strategies also has to be in place. So especially the bank-wide user access management part, and especially creating the unique and secure authentication across the bank, including the privileged access, and also wherever required, enabling the multi-factor authentication, such as for the payment platforms. So those things has to be established thoroughly throughout the banks, and the bank should follow the access to be granted on a minimalistic privilege for all users who need to have basis. So that is one of the key principles has to be adopted across the bank, and how the bank going to manage their remote access. So all these protective mechanism has to be in place. Then if you move on to the network and communication security, the basic principles when it comes to the having firewalls, network segmentations, and web application firewalls, not only having firewalls, but to also configure the security devices adequately in terms of having threat protection enabled for all outbound and inbound traffic. And also the next gen firewalls actually gives the facility to enable advanced threat protection, because if you take nowadays, most attacks are zero-day attacks or the advanced attacks. So in that case, you need to have these facilities in a bank as a primary function to enable bank to protect from these kind of attacks. So, and one of the key important thing is the network segmentations. But if you take the most of the attacks happen throughout the history is by attacker leveraging on a weakness on a network and then subsequently subsequently moving towards from the weak point to the critical segments of the network. So network segmentation is really important, where you can actually retain particular attack or a attacker or even a malware attack within the particular network segment, where without you letting your critical segments to also get damaged. So that's why this critical network segment, even if you take the standard like a payment card industry standard like a PCI DSS, the payment card related network segmentation is really important as well. So if you if we go to the next item of the data security, so identifying the data inventories, data flow maps, data dictionaries, so all these aspects has to be considered when it comes to data security. So data security has to be in bank should have a data governance framework. So the framework should have the way to basically identify what are the key elements when it comes to the data, what are the classification part, the data quality parts, data security part, what are the protection mechanisms bank going to place, and what's the encryption mechanisms bank's going to place. So those things has to be in place. So if we move into the detection part, so the anomalies and the detection is one of the key elements. So this where the SIEM related, the security information and event management kind of systems actually become really handy to a bank. So especially when you have a security operating center, although you have all these preventive controls and the detection controls, the controls are in place, without a detective control, if something goes wrong in a bank, you will not be able to detect it. So that's why where these security SIEM kind of systems, where the security all the logs are actually correlated to a single device, and where you actually do correlation, disk-based correlation to detect events. So those things have to be in place in the bank. So actually my paper elaborates more checklist kind of items has to be implemented as part of the detection mechanism. So these controls actually helps a bank to build a more prominent detective mechanisms. And also what is the next item is the response. So response strategy is what is the response strategy bank in place. So basically bank should have a cybersecurity response policy in place. So in case of a cyber attack, how the bank going to respond, so whether it is part of the bank's regular incident management process, and also who can declare it as a disaster, and who actually initiate the call trees, and who are the important contact points in case of a cyber attacks, and who going to initiate this call tree. So those things has to be properly documented, and even up to the extent who's going to handle what is the media statements and what is the publications you are planning to do, how you gonna what is the statement you are going to publish to your website. So all these has to be properly documented, unless you will be only realizing all these aspects when it's actually when you are facing a cyber attack only. So at that time, with the panic mode and all, people will not be able to really kind of go through that panic mode and establish this kind of and enable all these functions at that moment. So it's always better to have a proper response strategy. Then when it comes to the recovery strategy, the bank should have a mechanism or a strategy to recover from a cyber attack. So what is our recovery strategy? As we spoke about earlier, the cyber insurance could be one of the recovery strategies. So and in case of our primary site getting attacked, what's the recovery strategy to get, how we can get the operations back from our DR site. So those kind of things has to be properly managed and planned as a bank. So if I highlight key aspects through a timeline. So as I previously mentioned, highlighting my paper in a concise manner. So the governance is one of the key aspects where the bank should have to follow, where the practices like establishing the CISO function in the bank, and establishing ISSC function, policies, procedures, procedures, and standards. Again, so generally the NIST is one of the key standards most bank adopt, and also the ISO 27001 standard, PCI DSS standards. So all these standards has to be give you a kind of a framework to work with in terms of by you to enabling security controls across the bank. So raising user awareness is one of the key things when it comes to bank. And one of the key principle bank has to follow the security by design in everything. So the security has to be considered one of the key element when it comes to everything bank, including the projects, whatever the product the bank lose, and even the services, and even designing. But rather at the later point when before a product launch, the security has to be as a practice should be not to check security before we launch a product. Not only that, so but also by design, even from the inception of any product or service, the security has to be adapted. So that should be as built in as part of a culture. And the key security investment also has to be in place. So such as the SIEM systems, the data leakage prevention system, encryption, security operating center, patch management practices, web application firewalls. So those practices has to be in place, and security investment has to be in place to ensure that the security prevention mechanisms are already in place in the bank. So when it comes to cyber resilience assessments has to be done from a bank on a regular basis. So security testing, cyber drills, incident response effectiveness, and the ethical hacking kind of activities, and also the red team kind of, blue team kind of activities has to be done to check the cyber resilience of the bank. Not least and not the least, it is the continual improvement of cyber security program. So basically that you need to have your KPIs, KRIs defined, the PDCA cycle, the plan, do, check, act cycle has to be run on a regular basis, your security dashboards, and you have to use the intelligence to predictive analysis also should be part of your decision making when it comes to cybersecurity preparedness. So I have highlighted all the key elements of my paper in a very concise manner for a bank. And I would open to take any questions.
Thank you, Suresh, for a very comprehensive presentation. What I would like to do now is to get your views on future policy advocacy work. I think the president of the ABA made in his opening comments a view that it would be good if we could have the Policy Advocacy Committee more frequently, have it once in 6 months, and then consider 6 papers every 6 months in order that we would have more interaction and more learning shared with the member banks. Again, soliciting papers from our partners as well as from our member banks. Can I have some views around the committee on some of the areas that you think we need to do more on in the future?
If I may, I have a topic for suggestion.
Please.
Currently, there are a large number of banks who are developing commitments to decarbonize their portfolios using science-based targets. This is in support of national and international efforts to tackle climate change. Most of these efforts are being promoted by financial institutions and banks based in Europe and Japan and US, but perhaps your members might also benefit from a policy paper on the topic.
So when you say decarbonized portfolio, you mean making individual organizations carbon neutral and also for the carbon that they generate?
Yeah, so reducing the greenhouse gas emissions associated with the assets and other sort of services within the portfolio.
Excellent idea. Thank you very much, Dr. Fenton. Would you like to volunteer your organization to be able to do a follow-up paper on this area?
Yeah, certainly can. So WWF, along with some partner organizations, CDP, WRI, and UNEPFI, have recently finalized methodology for financial institutions to adopt science-based targets, and would be happy to provide a paper.
Great, thank you very much. Mr. Wong?
So you're asking about whether we should increase the frequency, right? Rather than every 6 months, whether we can, well, I have no objection of that, because I think it's up to the member to consider, right? I mean,
for the moment, it's 1 year, but what was being proposed, given that we are in an online environment and we cannot physically, meet, whether we could have the knowledge sharing on a more frequent basis and make it once in 6 months rather than once a year when we engage in this manner.
Yes, that's why I'm supporting, especially if you ask my own opinion. With this this virtual meeting, right? That we using this technology, I think it's very convenient nowadays. Rather than we traveling around, and sometimes very difficult to make our time, traveling. Especially we don't know when this COVID-19 pandemic situation will be finished.
Sure, we need to make the best out of the situation. Yes.
Yes. Yeah.
Any other thoughts? Of course, we do miss the food, drinks, and the conferences and the entertainment. But I mean, this is the second best option. And even entertainment can be built into some of the, online Zoom meetings. I've seen that happening in some, get-togethers that we have. So that's really about adapting to the new normal, isn't it?
Yes. Yes.
Any other thoughts? Oliver, do you have any thoughts on future policy advocacy?
Yeah, first I'd like to say I think the choice of the topics today was a very good one. All very important, very relevant topics and all ongoing. So basically also I think we will have a number of future advocacy committee meetings where these topics should be on the agenda. I think every single one of them, there will be developments. So regular updates on these topics would be very called for. And also I agree also with Adrian. I think ESG is becoming super important, first for each of us personally, but also because a lot of our customers and investors now put a very high emphasis on this. So you cannot ignore this as a bank. Again, we're business people. We want to do something good, but we want to make money too.
The US elections also will make an impact on the whole perspective on climate change, isn't it?
Yeah, correct.
So Oliver, would you like to provide an update even at the next meeting on the LIBOR scenario? Because by that time, I think we'd have got into implementation phase 6 months from now. So then it will be more about how banks can adapt, how countries need to adapt and get onto the bandwagon more effectively.
Yep, definitely can do that.
That's fine. Maria, any thoughts from RCBC? Any areas you think would be more topical for us to consider for the future?
Right. Our regulators actually have implemented a sustainability framework already for all banks to follow. And so I think some of our banks might be challenged to see this through. So I think that would be one topic that we would like for the committee to consider, challenges in achieving the sustainability goals set by the regulators.
Yes, that would be great. Yes. And also something along the lines of, linking up with supply chains, linking up with using digital technology with our customers, setting up something along the lines of an open marketplace. I think you were alluding to that in terms of an app, the Maybank app, where you're creating this whole ecosystem for customers. I think that would be an area, maybe something along the lines of a case study that would be useful for our members, how to actually collaborate with our customers and support their banking efforts in a completely digitalized environment. So what we will do is, I think we will continue to engage with all of you. And on my side, I think one of the areas that I would like to share with you would be this whole, what we call the marketplace. We have at my bank over 100,000 customers ranging from microfinance, SME, project finance to medium to large corporates. And what we have done reasonably successfully in the last 7 or 8 months is to help build supply chain linkages, where in between our customers, we have created connections and found partners for them, and whilst at the same time supporting them with digital products. So that is something that I would like to share with the committee in the future, so I can do a paper along those lines. And I will continue to engage through the Secretariat with all the members and get their views in terms of volunteers for the policy advocacy inputs for work. So that's something that we will do immediately after we complete this session. Once again, I would like to thank each and every one of you for all the efforts that have been put in. Look forward to seeing all of you at some point in the near future, online, or my preference would of course be physically. Thank you very much.